Hello, everybody, and welcome. I have a special guest today. Her name is Charee, and she is an insurance expert. And so I decided to do a podcast format. It's a little bit different, but you're going to get a different perspective than just mine. And so I think this is going to be very valuable. We're going to have maybe a little bit of a debate, but she's going to share with you more information than I'm able to because she is licensed in insurance. So we'll start with introductions. Cherie, why don't you tell us a little bit about your background, what your specialty is, and where people can find you?
Hello, everyone. My name is Charee. I'm a life license advisor based in British Columbia. I am also licensed to operate in Alberta, Quebec, and Ontario. So I was a registered nurse back then, looking after patients, but now I am fully dedicated to giving financial education and helping Canadians uh, achieve financial uh, peace of mind.
Okay, great. And what's your
Thanks for
channel where
having me.
people? Uh, yeah, I'm happy you're here. What's your channel where people can find you?
So on TikTok, I'm at Insure Talk.
Okay, perfect, perfect. And just a quick background for myself. So I worked in IT for 20 years until I achieved financial independence. And because I also accumulated a bunch of investing and personal finance knowledge, I started Canadian Money Talk, both on YouTube and on TikTok, just so I can help people achieve the same financial independence. Because trust me, not having to go to work is great, and be able to spend time with family or whatever your preference is. More specific uh, type of insurance is mortgage insurance, which uh, is only going to cover if you pass away, is going to pay off your mortgage. Um, can you talk about that a little bit and maybe compare it to term life and suggest which one may be more appropriate?
Okay. So yes, when you get a mortgage, you may be offered a mortgage insurance, but know that there are other options like the term life insurance, and there are a lot of advantages to having your term life insurance instead of the mortgage one. Of the first being you can appoint the beneficiary to the term life insurance. With the mortgage insurance, it is the lender who is the beneficiary. The second is the amount that is covered for in a mortgage insurance will decrease as your mortgage payable decreases, but your term insurance coverage remain the same for as long as you have it and you're paying for it.
Right.
Okay. What else?
Just to add to that, the key point is as your mortgage principal decreases, the premiums generally will not,
That's true.
right? So it's covering less, but you're still paying the same amount for the mortgage insurance.
Yes, so it's more affordable to have the term life insurance in
And
this
it's
regard.
just more flexible, I think, because it goes, let's say, to a beneficiary or to even to your estate, it will pay off, it'll be used to pay off your mortgage, but it can also be used for other things,
Yes.
opposed to just paying off the mortgage.
Yeah. One other thing is if you switch a lender, you get to bring your life insurance to cover the remaining mortgage. Whereas with the mortgage insurance, you will have to requalify for the insurance if you change the lender.
Right, right. Okay, well that makes sense. So it just sounds like term life would be preferential to mortgage insurance in most cases.
That's right.
Cool. Let's talk a little bit about mutual funds, exchange traded funds, and stocks. So this is my department, but it will be a lead-in into segregated funds for Charee. So let's start with stocks and bonds. So a stock is ownership in a publicly traded company on a stock exchange, while a bond is a loan. It can be to a company, it can be to the government as well. And stocks and bonds are your basic building blocks, and they can be inside a bucket of investments, and those can take the form of mutual funds or exchange traded funds. Mutual funds are typically, but not always, actively managed, meaning there's a professional and a research team that makes decisions about what to include in that particular mutual fund. And there is usually higher fees, some of them as high as 2.5%, 3% per year of the amount that you invested and that you currently hold. Exchange traded funds typically are passively managed, meaning that they just follow some sort of a formula. They follow some sort of an index, uh, and there isn't anybody making decisions about what to include. You just try to follow the index. And those can follow the Toronto Stock Exchange Index, the Standard and Poor's 500, which is a US stock index, and many, many others. So those tend to have lower fees. They can be as low as 0.05%, 0.1, 0.2% is more usual for us Canadians. We're a little bit more expensive than US ETFs. So those are things that people can invest in on their own. And there are certain financial advisors which will invest your money into those items as well. So this is a segue for segregated funds, which generally run on top of mutual funds, and then there's some extra benefits thanks to the insurance. So, Charee, can you tell us a little bit about segregated funds?
Yeah, so segregated funds are insurance contracts that allow you to invest in a wide range of funds, and it comes with a lot of benefits. For example, there is a death benefit guarantee, there is maturity guarantee. You could also add estate planning in there, creditor protection,
Right.
and among many other things.
So I think some of the things you mentioned, there's usually two numbers after the name of the segregated fund. It's like a 75 or 100, and there's usually two numbers. So
Yeah,
can you explain what those numbers mean?
right. So 75, 75, or 75, 100, or 100, 100. So these are the classes. 75 means that so there is a guarantee for 75%. There is a 75% guarantee upon maturity, and the other 75 is a 75% guarantee upon death. So this one is more suitable for someone who has longer time horizon to invest,
Okay.
like younger people. And the other ones are suitable for estate planning and preservation of assets. for people who have less time to invest. So there are more guarantees. For example, the 100% guarantee, it ensures that even if the market value of your investment drops, there is a guarantee.
So the first number is a guarantee that after how many years? It's usually 10 or is it 15?
It depends. So for the 75, it's up to 105 years old. And for the other one is 15 years.
Right, but so let's say, just so we don't get confused, let's say the first number is a 75 and the second number is 100, just so we don't get confused.
Okay.
So the first number, the 75, is a guarantee that if after, and this is where I was asking, a 10-year period or a 15-year period, if the amount that the segregated fund is worth, if it is lower than what you invested, if it's below 75%, then the segregated fund company will bump it up to 75 if you want to sell it. Do I have that correctly?
Upon maturity.
And the maturity is it that 10 years or 15 years?
It's either 15 years or 105, depending on which one you chose.
Oh, I see. Okay, so
Yeah.
15 years.
Yeah,
Okay.
15.
So there is a guarantee that the principal is going to come back to you. But just to sort of play devil's advocate a little bit, over a 15-year period, there's very, very few stock markets which are down,
Mhm.
let alone down 25%.
Okay.
Plus, of course, inflation would have eaten away at the value anyways. But I guess it does give some amount of comfort. Of course, you can choose a segregated fund where the first number is 100, right?
Yes.
Right. Now, from experience, so those would probably have a slightly higher fee.
Yes, it will have
They will
more
have a higher.
guarantees, more fees. Yeah.
Of course, yeah. I guess the more bells and whistles on anything, the higher the cost. So
Yeah.
that was the first number. Now the second number is a guarantee you sit upon death.
On death.
So segregated fund has an insurance wrapper around it, and so if you're elderly, then you can put money into this, and upon your passing, you have a guarantee of the second number that's what's going to go to your beneficiary or your estate.
Yes. So you can appoint a beneficiary. And the good thing about this is that the investment goes quickly to the beneficiary, therefore bypassing the probate and the probate fees. So
Right.
if this is something that the clients are looking to have, the comfort of not having to think about going through the lengthy process of probate, then this is a good product for them.
So this would be something people might use to pay for their funeral, because if it's a nice funeral, it can go 10-20,000 fairly easily. And if the estate is locked up in probate, then their family would have to come up with the money for the funeral, while if you have a segregated fund, then that money becomes available upon your passing.
Yes, not only that, so there will be some savings on accounting fees, legal fees, some other fees that are involved during the probate.
Right, right. So just to play devil's advocate a little bit, a way to go about this is just to take the expected cost of your funeral and then just give it to whoever you think is most reliable in your family and isn't going to go on a vacation with your funeral money. Um, is that something in your experience that works rather than doing a segregated fund?
Um, can you say that question again? Sorry.
I'm just saying an alternative rather than to use a segregated fund for funeral expenses, for example, that you just take cash and you give it to your most reliable family member. Is that something now that works?
But most would think about leaving something for the family, like an inheritance or something.
Right. So do
Right.
people do
So
people use segregated funds for inheritance, like for larger amounts?
it could be used for inheritance, right?
Okay.
But like
But I thought the benefit was the bypassing of the probate.
that is just one of the benefits.
Right. Okay. Uh, and then you mentioned creditor protection. So that's for if you're nearing bankruptcy, for example, you could put money into a seg fund and then your creditors couldn't go after it.
It doesn't mean that it can be used for that purpose, but that will give the protection
Okay.
should this situation applies to the client. But I
Okay.
mean, it doesn't mean that if they're nearing bankruptcy, they're gonna use it. It's not acceptable.
No, no, you shouldn't do that. I think if you're nearing bankruptcy, you're
Yeah,
not going to be investing into anything anyways. You're
yeah.
going to try to pay off your debts, hopefully. Um, okay. Any other kind of benefits? And who do you think would be somebody who would benefit from a segregated fund? You mentioned young people.
Mhm.
I guess old people because of the or elderly because of the death benefit. Um,
Guarantees.
yeah. Any like is it basically a good for everyone?
I wouldn't say any product is a one size fits all. It all depends. Like for example, if the client is someone who wouldn't have time to research and understand the investments in a certain fund, they could use segregated funds because it is managed by uh, professionals who are dedicated into just looking after these funds. They don't have to research whenever they have to buy or sell.
Okay. But what would be the benefit of the underlying mutual fund just buying that versus buying the segregated fund? Like who would benefit from the insurance aspect of it, the extra benefits? We sort of said elderly. Is anybody else or
Um, well, if you're someone who would like to as well diversify your investments, then this could be a vehicle.
right?